Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. It's Quincy Krosby. This is The Talking Point. It is Monday morning, October 9th. The market is due open very shortly. The futures are down, but not dramatically so. Oil prices are up, but not dramatically so. Let me point out that this week is a very important week for the market, even just in terms of U.S. economic data and the official opening of the earnings season. But obviously, there is tremendous focus on the conflict in the Middle East. I want to go over some of the implications just in terms of the market. First of all, natural gas prices are up. It's hitting Europe. The reason is that the Israeli Energy Ministry told Chevron, which has a platform 12 miles from the Gaza Strip, to shut it down. This isn't the first time this has happened. And obviously, when you shut down a natural gas facility installation, the prices are going to rise. In terms of crude oil prices, they have climbed a bit higher, but at this stage, they are rather contained. Obviously, the reason is that the conflict remains contained as we do this call in the morning. The reason for that is that it appears that Israel is just determined to focus on the Hamas stranglehold in the Gaza Strip. That region, whether Israel and the Gaza Strip, it doesn't have oil production. The concern is, and the overwhelming concern is, from many fronts. Obviously, energy is one of them, but in terms of a broader war, a deeper war, is that this conflict can expand and expand dramatically into the Middle East, bringing in players from all sides. This would be probably the reason that Iran is a focus right now, because you may remember yesterday in the news, Hamas said that Iran helped them dramatically in terms of logistics, in terms of planning. And Iran, of course, now has denied those reports. China is involved with the U.S. and the EU in trying to contain this escalation of fighting so that it does not expand into the region. Oil prices right now are hypersensitive to any suggestion that this is going to go beyond the immediate border of Israel, the immediate border of the Gaza Strip. Hypersensitive. This is a headline-driven market, and any chatter, any rumor could push the prices up and up dramatically, obviously. But as long as the market feels that diplomatic efforts are working and that this will not expand, oil prices should remain somewhat contained. We came into the market this week that oil prices were actually oversold. And when you have an oversold commodity, an oversold stock, an oversold market, it doesn't take that much to underpin a push higher. And that is exactly what I think you're seeing in the oil market. Obviously, there was going to be a move higher. But if the market believed that this was going to be include an expansion into the oil-producing regions of the Middle East, particularly Iran, we would see oil prices, to say escalate is an understatement. So again, the market is hyper-vigilant, hyper-alert, and we'll be watching for that. In addition to all of this, the fact remains that if, and this is a big if oil prices escalate to the point that they become a deterrent to growth in the United States, it appears as if from rumors and reports that the U.S. administration is prepared to take out more oil from the Strategic Petroleum Reserve, as they did when the Ukraine-Russia conflict began. Keep in mind that reserves are down dramatically and they have not been replenished. But nonetheless, the administration appears to be poised, if necessary, to go in and take out more oil. Now, in terms of the market here in the United States and in terms of economic data releases, which this week is so important. First of all, we have a bit of Fed speak. I'm going to point to today because Fed Governor Jefferson is going to speak. We want to listen to what he has to say, given his role within the Federal Open Market Committee, the Fed's Open Market Committee, the FOMC. He usually now speaks very much in terms of what the chairman is thinking because he is the vice chair. So we're going to listen to what he has to say. Tomorrow, on Tuesday, October 10th, I'm paying very close attention to the National Federation of Independent Businesses, the Optimism Index. This is still low, although it is climbing incrementally higher, but it is still low. It is important, and the reason is that the small business owners in our country are the backbone of the country for hiring. And also, they are very focused on sales. They're very focused on, how much money do they expect to be coming in? And therefore, they are just, how do I say this, focused on what they're going to spend in terms of capital expenditures, in terms of hiring expectations. And they are very, very much focused on higher prices that they may have to pay. What we want to see and what I want to see is if they are suggesting that higher prices have continued to climb, or are they pulling back and are we seeing prices come down? They are the most granular of the businesses in our country. So that will be tomorrow. And again, I'm paying close attention to that. Wednesday is very important because we're going to have the Fed minutes from the September meeting. Normally, I just pay attention and say, okay, great. But, every single nuance now matters to find out what are they thinking. And granted, after that meeting, we had a press conference. After that meeting, there's been a, string of Federal Reserve speakers reacting to the latest data. So the Fed minutes doesn't have the prominence that it used to have before all of this so-called transparency from the Federal Reserve. Still, the market's going to pay very close attention just to see if there's anything that we have missed. I know it may sound odd that we focus on it, but think about this. The market is concerned that there will be another rate hike, whether it is in November or December. Perhaps we can glean something from the Fed minutes. Also on Wednesday is the core producer price index. Now, this is important because there is a concern that prices may have been climbing again, and we'll see whether or not it is picked up in the producer price index, which basically is, if you can think of it as a tunnel of how products go from the beginning to the end and the price when it comes out and all of the prices that are paid during the process. So this is going to be important, especially amid a backdrop of concern over where the Fed is going to end its campaign to quell inflation. And then, obviously, I think most people know this because before the issues in the Middle East, this became the most important for this week. And that is on Thursday morning, the Consumer Price Index. And obviously, the concern is core and whether or not we are seeing a faster move down. This is what no one is expecting, that it's going to go to 2%. That is not the expectation. But it is that what is called the last mile in the central bank's fight against inflation is always the most difficult. And now the concern is, have we untangled the stickiness in that last mile? Or are we going to see inflation higher in the core than initially expected? I do want to point out that there are a number of analysts suggesting that we may just see the core a bit higher, or or not coming down fast enough below 4%. So in any sense, now remember, there's core CPI year over year, and there is CPI, not core, year over year. So we have to distinguish between that. And remember, the initial reaction, the knee-jerk reaction in the market is swift. And I want to mention this because people always say, how can it be so quick, Quincy? How the second this comes out into the market, the yields in the 10-year Treasury, the yields in the 2-year start moving immediately. Not to mention the futures market, because this comes out at 8:30 Eastern Time. It is because algorithms are increasingly sophisticated and knowledgeable, and they move the markets. The humans come in later, but those algorithms get there first, and they are fast, they are knowledgeable, and they don't leave a second for human thinking and processing of the information. So we will watch that as that comes out. The other aspect that I'm going to watch is when those numbers are released. Soon after, we will see whether or not the Fed funds futures market moves also. And does it move towards more expectation for a rate hike, particularly in December. Not so much in November, but particularly in December. We're already seeing that we are seeing an inching higher of expectations for a rate hike in December. So this is going to be important in shaping expectations for it. Now, I want to also mention, this is not the Fed's preferred measure. Obviously, the personal consumption expenditures index that's the PCE. But nonetheless, at some point, the CPI, Consumer Price Index, and the PCE converge. Ultimately they converge. They're different surveys, but they converge. So we'll keep our eye on that. And then on Friday, we're going to have the Consumer Sentiment Preliminary Report from the University of Michigan. I am watching, in particular, what consumers are saying about future inflationary expectations. They have been anchored, well anchored, meaning that it's not moving. Consumers are not saying, gee, I see inflation much higher in the future. That is something central banks and the Fed, in our case, do not want to see. But they've been anchored, they've been tight. But with gasoline prices climbing higher, we want to see if that has started to affect consumers' expectations of future inflation. That will come out on Friday morning. So in addition to watching everything that's going on in the Middle East, oil prices, take a look at gold prices. Gold prices have been higher, again, as a safety mechanism, obviously. We will watch the Treasury market. Treasury market is closed today, Monday, for the holiday. The bond market is closed, but we'll see where we start to see pricing. Remember, this week, what we want to look at is, especially when the CPI comes out, Consumer Price Index, is the 2-year. Remember, the 2-year Treasury yield is the most closely associated with Fed policy, monetary policy, and we will watch the 10-year as well. We also this week are going into the official opening of the earnings season, and we could go on, and you know how that happens. But let's pay attention to what we hear from J.P. Morgan on Friday, and the reason is they have a very, very deep role in the economy, from everything from loans, corporate loans, commercial loans, consumer loans, credit cards. And that is incredibly important for us right now because you are hearing reports that consumers are slowing down their repayment of the credit cards, that the delinquency rate is slowly inching higher. We want to hear from them, and we will hear from them, how they are seeing their credit cards, payments taking place. This is going to be very important, not to mention their view of the overall economy, what their own customers are saying, what their clients are saying. Guidance is uppermost in this market now, as the market tries to figure out what kind of landing are we going to have, what kind of finish to 2023 are we going to have. And we're going to get that assessment from the guidance from the companies that we hear from. So again, this week, very, very important, but we also have to be mindful of the price of oil, and also let's keep our eye when the Treasury market opens, whether or not, and this is important, we see a tremendous surge in buying of U.S. Treasuries for safety reasons. The more buying that we have, the more, by the way, the yield comes down. That's important. So we'll take a look and examine that overnight. This week also, I do want to point out in this call that the surprise payroll report, and it was in fact a surprise, the market was only expecting about 170,000 new jobs, and it was over 300,000 new jobs, and there was an upward revision to the month before. The labor market is resilient. However, bit of good news was that the wages leveled off. The rate of increase in wages leveled off. And that's what the market wants to see. Why does the market want to see that? Simply because that's what the Fed wants to see. You know, the market is interpreting everything that they believe, how it will be interpreted by the Federal Reserve. And so that was a bit of good news. But let's keep in mind, as I end this call, that when the rates climb higher, if they are climbing higher because of a strong economic underpinning, at some point the market will be able to absorb that, as opposed to the rates climbing higher because inflation without economic growth is moving higher. You know, that's called stagflation. So the report that we had from the employment report on Friday was positive in the sense that as long as the labor market remains solid, consumers will be in a situation where they can continue spending, albeit carefully and much more deliberate. And there still remains worry, by the way, in the consumer area that jobs are vulnerable, that they may not be able to find a job. We've seen that in many of the consumer sentiment reports. However, we need to be mindful of the fact that the way that this works is the labor market strength then helps underpin the consumer, representing 68% of our economy. During this earnings season, we will be paying attention to whether or not companies feel that they need to cut costs. And if they do, will it be reducing labor? That's going to be extremely important during this earnings season. So have a very good week. We will be mindful and we will be watching events in the Middle East from many perspectives. But for our concern right now, it is the perspective of the market. So take care, stay safe, and thank you so much for joining me. I so appreciate it.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are or generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.